There's something happening right now in the gold market that nobody saw coming. And I mean nobody. Not the analysts at Goldman Sachs, not the traders at the COMEX, not even the central banks who've been accumulating gold like their lives depend on it. It's a generation that was supposed to hate gold, a generation that grew up on smartphones and crypto, a generation that financial advisors wrote off as digital natives who would never touch physical assets. Millennials and Gen Z are buying gold at rates that are absolutely shattering every projection. And when I show you the numbers, when I walk you through what's actually driving this, you're going to understand why this changes everything about where gold prices are headed in the next 12 to 18 months. Let me start with something that happened 3 weeks ago that barely made the news. The World Gold Council released their Q4 demand report, and buried in the data was a statistic that made me read it 3 times to make sure I wasn't misunderstanding. Gold bar and coin demand from investors under 45 years old increased by 127% year over year in North America alone. Not 27%, 127%. But here's what makes this absolutely fascinating. This isn't happening because young people suddenly discovered gold exists. It's happening because of a perfect storm of factors that are fundamentally reshaping how an entire generation thinks about money, wealth, and financial security. Think about what someone who's 28 years old right now has lived through. They graduated college right into the 2008 financial crisis or its aftermath. They watched their parents lose homes, lose retirement savings, lose faith in the system. Then they entered the workforce during the slowest wage growth period in modern history. They've seen 3 major market crashes, a global pandemic, inflation that destroyed their purchasing power, and a housing market that's completely locked them out of homeownership. And here's the kicker. They watched Bitcoin go from $200 to $69,000 and back down to $16,000. They saw FTX collapse. They watched Luna implode and wipe out $40 billion in a weekend. They learned the hard way that digital gold isn't actually gold. So what are they doing now? They're buying the real thing. And they're doing it through channels that didn't even exist 10 years ago. I want you to understand the scale of what's happening. Robinhood, the platform that became famous for GameStop and meme stocks, added gold trading in 2024. In the first 6 months, over 2 million users under the age of 35 bought gold through the platform. The average purchase? $847. These aren't wealthy investors. These are regular people who are taking money they used to put into crypto or tech stocks and redirecting it into physical gold. But that's just the beginning. There's an app called Glint that lets you buy gold by the gram and spend it with a debit card. Their user base has grown by 340% in the last 18 months. The average age? 31 years old. These people are literally using gold as their everyday money, the way their grandparents might have imagined but never actually did. Then you've got companies like OneGold and Vaulted that are making it possible to buy fractional gold ownership with no minimums. A 22-year-old can buy $50 worth of gold from their phone while sitting in a coffee shop. And they're doing it. In massive numbers. The data from these platforms is absolutely stunning. During the banking crisis in March 2023, when Silicon Valley Bank and Signature Bank collapsed, gold purchases from users under 30 spiked by 890% in a single week. Not 89%, 890%. These young investors saw the cracks in the banking system and their immediate reaction was to buy gold. But here's what's really interesting. When you look at the surveys and interviews with these buyers, they're not talking about gold the way their parents did. They're not buying it because some financial advisor told them to have 5% of their portfolio in precious metals. They're buying it because they fundamentally don't trust the system anymore. I read an interview last month with a 26-year-old software engineer in Austin who has $23,000 in physical gold stored in a private vault. He said something that stuck with me. He said, "I watched my dad lose half his 401k twice. I watched my friends lose everything in crypto. I watched inflation eat my salary. Gold is the only thing that makes sense anymore." That's not a boomer talking. That's not a gold bug who's been preaching about sound money for 40 years. That's a millennial who learned through painful experience that the traditional financial system is not designed to protect his wealth. And this is creating a demand dynamic that the gold market has never seen before. Because unlike previous generations who bought gold and stuck it in a safe deposit box and forgot about it, this generation is actively engaged. They're tracking prices daily. They're in Reddit communities and Discord servers talking about premiums and delivery times. They're comparing vault storage fees and researching the best dealers. They're also doing something that's absolutely crucial to understand. They're buying physical. Not paper gold, not gold ETFs, not gold mining stocks. Physical bars and coins that they can hold or that are allocated in their name in a vault. Why does this matter? Because the gold market has operated for decades on the assumption that most gold demand would be satisfied with paper claims. The COMEX futures market, the LBMA in London, the various gold ETFs, they all work on the principle that most people are happy to own a piece of paper that says they own gold, without ever taking delivery of the actual metal. But this generation doesn't trust paper claims. They lived through 2008 when paper claims on mortgage-backed securities turned out to be worthless. They watched Lehman Brothers collapse. They saw MF Global steal customer funds. They know that when things go wrong, paper promises evaporate. So they're demanding physical, and this is creating stress in the market that most people don't see yet. Let me give you a specific example. In November 2024, the U.S. Mint reported that they sold 142,000 ounces of American Gold Eagles. That's the highest November sales figure in the history of the program. And when they surveyed their dealer network to understand who was buying, the dealers reported that 68% of purchases were from first-time buyers under the age of 40. The Royal Canadian Mint reported similar numbers. The Perth Mint in Australia saw record demand from younger buyers. This is a global phenomenon. And here's where it gets really interesting from an investment standpoint. This demand is sticky. When older generations bought gold, they often sold it when prices went up or when they needed cash. But the data shows that younger buyers are holding. They're not trading in and out. They're accumulating. There's a 29-year-old in Denver who's been buying 1/10-ounce gold Eagles every month for the last 4 years. He's never sold a single coin. He calls it his anti-system savings account. He's not alone. The average holding period for gold purchased by investors under 35 is over 3 years, compared to less than 18 months for older investors. This creates a completely different demand profile. It means that gold that's being bought by this generation is essentially coming off the market. It's not going to be sold back when prices hit $2,400 or $2,500. It's being held as long-term wealth preservation. Now, let me connect this to something else that's happening that most people aren't paying attention to. The inheritance wave that's about to hit. Baby boomers currently control about $78 trillion in wealth. Over the next 20 years, that wealth is going to transfer to millennials and Gen Z. It's going to be the largest wealth transfer in human history. And here's the question that should keep gold bears awake at night. What are millennials going to do with that money when they inherit it? They're not going to leave it in the same 60-40 stock and bond portfolio their parents had. They don't trust bonds after watching yields destroy bond values in 2022. They're skeptical of stocks after seeing multiple crashes. They're terrified of real estate after being priced out of the market for years. But they trust gold. They've already shown us they trust gold. They're buying it now with their own money, even though most of them don't have much. What happens when they inherit serious wealth? I'll tell you what happens. A significant portion of that $78 trillion is going to flow into physical gold. Not all of it, obviously. But even if it's just 5%, that's $3.9 trillion in new gold demand over the next 2 decades. To put that in perspective, the entire global gold market is about $13 trillion. The annual gold mining supply is worth about $200 billion. If even a fraction of this inheritance money flows into gold, it will overwhelm the available supply. And this brings me to something I think is really important to understand if you're thinking about your own financial security, especially if you're in or near retirement. The traditional advice has always been to have some gold as portfolio insurance, maybe 5%, maybe 10%. But that advice was based on a world where gold demand was relatively stable and predictable. Central banks bought some. Jewelry demand was steady. Investment demand fluctuated but was manageable. We're entering a completely different world. A world where an entire generation that's been burned by every other asset class is turning to gold as their primary store of value. A world where that same generation is about to inherit the largest pool of wealth in history. A world where physical demand is overwhelming paper supply. If you're sitting on retirement savings in traditional accounts, there are ways to position yourself for this shift. Gold IRAs, for instance, let you hold physical gold inside your retirement account without tax penalties. I put together a free guide that explains exactly how this works, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. If you've got $100,000 or more in retirement accounts, it's worth understanding your options here. But let me get back to the bigger picture, because there's another layer to this story that makes it even more compelling. This generation isn't just buying gold because they don't trust the system. They're buying it because they understand something about monetary policy that took their parents decades to learn. They grew up watching the Federal Reserve print trillions of dollars. They saw the money supply explode after 2008, then again after COVID. They watched inflation destroy their purchasing power while the government insisted inflation was transitory. They understand, intuitively, that the dollar is being debased, and they're not waiting for permission from financial advisors to protect themselves. They're taking action. There's a fascinating study that came out from the University of Chicago last year. They surveyed 5,000 Americans between the ages of 25 and 40 about their views on money and inflation. 73% said they believe the dollar will lose significant value over their lifetime. 61% said they're actively looking for ways to protect their wealth from currency debasement. And 44% said they've already bought gold or silver as a hedge. Think about that. Nearly half of young Americans have already bought precious metals. This isn't fringe behavior anymore. This is mainstream. And it's not just Americans. In China, young people are buying gold jewelry not as adornment but as savings. There's a trend called gold beans, where young Chinese are buying tiny gold beads that they can accumulate over time. It's become so popular that it's driving a significant portion of China's record gold demand. In India, millennials are buying digital gold through apps like Paytm and PhonePe. They're buying it in amounts as small as 1 rupee. The total digital gold holdings in India have grown from essentially zero 5 years ago to over $2 billion today. This is a global phenomenon. An entire generation, across multiple countries and cultures, is simultaneously deciding that gold is the answer to monetary instability. Now, let me show you what this means for gold prices, because this is where it gets really interesting. The gold market operates on relatively thin margins between supply and demand. Annual mine production is about 3,500 tons. Recycling adds another 1,200 tons. So total supply is around 4,700 tons per year. On the demand side, jewelry typically takes about 2,000 tons. Central banks have been buying 1,000 plus tons per year. Industrial use is about 300 tons. That leaves about 1,400 tons for investment demand. But here's the thing. Investment demand has been running much higher than that. In 2023, investment demand was over 2,000 tons. The difference was made up by ETF outflows, people selling existing gold back into the market. But what happens when that selling dries up? What happens when the new generation of gold buyers doesn't sell? What happens when they keep accumulating, month after month, year after year? You get a supply deficit. And in a market with inelastic supply like gold, where you can't just produce more quickly, deficits lead to price spikes. We saw this in 1979, 1980. Investment demand surged as inflation raged and confidence in the dollar collapsed. Gold went from $200 to $850 in less than 2 years. We saw it again in 2009, 2011, after the financial crisis. Gold went from $800 to $1,900. But both of those were temporary surges. Demand eventually normalized. Prices came back down. This time is different. This isn't a temporary panic. This is a structural shift in how an entire generation thinks about money and wealth. This demand isn't going away. It's going to grow. And there's another factor that's going to accelerate this: social proof. Right now, if you're a 25-year-old and you tell your friends you're buying gold, you might get some weird looks. But that's changing fast. As more young people buy gold, as it becomes normalized in their peer groups, the adoption curve is going to steepen dramatically. We saw this with crypto. Bitcoin went from a fringe curiosity to something every young person had an opinion about in just a few years. The same thing is happening with gold, except gold has 5,000 years of history proving it works. There are YouTube channels and TikTok accounts dedicated to gold stacking that have millions of followers. Young people are posting videos of their gold purchases, showing off their collections, teaching each other about premiums and purity. This is creating a cultural shift that's going to drive demand far beyond what any analyst is currently projecting. And the gold mining industry is completely unprepared for this. They've been underinvesting in new production for years. The major discoveries are getting smaller and more expensive to develop. The average grade of gold ore being mined is declining. It takes 10 to 15 years to bring a new mine online. There is no way the mining industry can ramp up production fast enough to meet this surge in demand. Which means the only way the market can balance is through higher prices. How much higher? Let's do some math. If millennials and Gen Z allocate just 3% of their current wealth to gold, that's about $750 billion in new demand. The total value of all the gold ever mined is about $13 trillion. So we're talking about a 5 to 6% increase in total demand. But remember, most of that gold is not available for sale. It's in jewelry, in central bank vaults, in temples in India. The amount of gold that actually trades is much smaller. So a $750 billion increase in demand would have to be satisfied by a much smaller pool of available gold. If we assume that only 20% of above-ground gold is potentially available for sale, that's $2.6 trillion worth. A $750 billion increase in demand against a $2.6 trillion available supply is a 29% increase in demand. In a market with inelastic supply, a 29% increase in demand doesn't lead to a 29% increase in price. It leads to a much larger increase, because sellers demand a premium to part with a scarce asset. If we use historical precedents, a demand shock of this magnitude could easily push gold prices up 50 to 100% from current levels. That would put gold somewhere between $3,600 and $4,800 per ounce. And that's just from the current wealth of younger generations. That doesn't include the inheritance wave. That doesn't include the possibility that this generation allocates more than 3% to gold as they get older and accumulate more wealth. Some analysts think gold could hit $10,000 per ounce within the next decade. A year ago, I would have said that was crazy. Now, looking at these demand trends, I think it's possible. But here's what I want you to understand. This isn't about trying to time the market or make a quick profit. This is about recognizing a fundamental shift in how wealth is going to be stored and protected over the next 20, 30 years. If you're in your 50s or 60s, you need to understand that the financial world your children and grandchildren are inheriting is radically different from the one you grew up in. They don't trust the institutions you trusted. They don't believe in the same financial instruments. They're creating their own playbook, and that playbook has gold at the center of it. The smart move is to position yourself ahead of this wave, not try to catch it after it's already crashed over the market. Because once gold breaks above $3,000 and stays there, once the mainstream media starts covering this generational shift, once your neighbors are talking about buying gold, the premiums are going to explode, and the availability is going to disappear. We're already seeing signs of this. Premiums on American Gold Eagles are running 6 to 8% above spot price. That's high by historical standards. Delivery times from major dealers are stretching out. The U.S. Mint has had to ration sales to dealers multiple times in the last year. This is what the early stages of a supply crunch look like, and it's only going to get worse as more people wake up to what's happening. I want to leave you with one final thought. Every major wealth transfer in history has been accompanied by a shift in how wealth is stored. When the Roman Empire collapsed, people stopped trusting Roman coins and went back to gold and silver. When the British Empire declined, wealth shifted from pounds to dollars and gold. When Bretton Woods ended in 1971, gold went from $35 to $850. We're living through another one of these transitions right now. The dollar-based financial system that dominated the last 80 years is being questioned by an entire generation that's watched it fail them repeatedly. They're not waiting for the system to fix itself. They're opting out. And they're choosing gold. The question isn't whether this is going to drive gold prices higher. The question is whether you're going to position yourself before it happens. Or after. Because this train is leaving the station, and it's not coming back.